Good morning everyone and welcome back to Morning Markets here at True Potential on Wednesday the 31st of January. Today we're going to discuss the most recent inflation data from Australia and France, what we think it means for the outlook for interest rates, and also we'll reference the most recent survey data for economic activity in China. So inflation data for Q4 has just come out overnight for Australia, and it points to the lowest inflation print there in 2 years. And this measure of inflation momentum, which we've discussed with you before, that is that the most recent inflation prints in economies are the most worthwhile for trying to get a trend for future inflation. This points to Australian CPI being back towards target by the middle of this year. Further afield into Europe, we've had French inflation for the month of January, and inflation momentum there is very low. In fact, it's well below 2%. It's actually 0.5% over the last 9 months. And with base effects for the remainder of the winter, particularly high for France this year, it points to inflation into the spring being materially below 2%. So if we bring this all together and we think about how the US is ahead in its disinflation narrative, it's going to be very difficult for central banks not to talk about interest rate cuts over the next few months, particularly in the US, given that it's the one major central bank which already forecasts interest rate cuts in their official projections. And of course, we have the meeting of the Monetary Policy Committee in the US this evening. And given that inflation in the US has recently surprised to the downside, and that inflation for the year of 2023 came in below forecast, it's likely that Chair Powell this evening will have to reference these downside inflation misses and what it means for the outlook for monetary policy as we go ahead. But of course, these misses in inflation are actually healthy for growth. It supports consumption in consumption-oriented economies. And indeed, we saw further evidence of strength in the US with some jobs survey data yesterday, which points to a normalisation in measures between job openings and job quits. And in fact, this quit rate is now back to where we were pre-COVID. And in fact, wages should follow this path of disinflation in the US as well. So tonight, the Federal Reserve can perhaps take some solace from the fact that a number of broad measures of inflation point towards further declines in price pressures. But it's not all good. We've had further survey data out of China for the month of January. These so-called PMI surveys are based on responses from business managers. And whilst the services component points to sluggish and sideways growth in the Chinese economy, the manufacturing data points to a continued contraction. And in fact, sentiment within that industry remains very low as the economy struggles there with the debt overhang from the residential pop in the bubble there 2 years ago. We know that policymakers in China are trying to ease credit conditions, but with interest rates already very low, there's not much room to ease further. However, the Western economies remain strong, inflation is falling, and we should expect that tonight the Federal Reserve in the US begin to reference rate cuts ahead. Thank you very much.